Welcome everyone to our next 5-2 investments presentation. My name is Martinus Oosthuizen and today is the 27th of July 2021. Our latest presentation is going to be done virtually today. I know that it is something new for our clients. We normally get together over lunch and we just chat about what's going on, and it's always great to get together. But with the current conditions with COVID, we have decided to do this virtually. I don't want to entice any one of my retired clients to come out to our presentation. So we've decided to do this virtually. So welcome to anyone else that has decided to watch this from wherever, all over the world. I'm pretty sure these things go far and wide these days. The topic that we will discuss today is the crash. Why this word, the crash? Well, let me show you why. I'm going to get into it into detail, and I'm sure that you're going to love this topic. Everyone's concerned at the moment with what's going on in the world, and why is it safe to invest with 5-2 investments? What makes us different, and why do I not have any sleepless nights? I know my clients must be thinking, how's that even possible? But I don't have sleepless nights, and I'm going to show you today why you should not have any sleepless nights as our clients either. So keep watching. 5-2 Investments is built on two pillars. The one is our software and systems, which is something in the back end that you as a client will not always interact with necessarily. And it's something that helps us to make our jobs easier. I have spoken about this in the past. My clients are aware of what we are doing in the market space that is new and that doesn't exist, and that's great, but that's not what today's presentation is about. Today we are going to talk about our investment blueprint, and we're going to unpack this. Our investment blueprint is made up of two components. The first one is our strategy, and the second one is our active management. So I'm going to talk about the active management first, and it is something that I have spoken on over the years. My clients all know that this is what separates us from the rest of the pack, and I know that this is probably one of the reasons that many people are our clients, because we take this very serious. And so I'm going to unpack this as I usually do. But then a little bit later, I'm going to discuss our strategy. And that is where the big emphasis comes on why I don't have sleepless nights. So please stay tuned until the end. So in active management, what is active management? Active management means that, as most brokers in our industry, they believe that it is the job of the asset manager to play an active role in changing portfolios and making decisions on a more constant basis. I don't have that stance. I believe that it is my role as a broker to know what's going on in the world, to stay up to date with news, with regards to anything that can pertain to investments, from macroeconomics to global news to presidential elections, even to the details of what's going on in businesses accounting on a micro scale. So let's unpack this and you'll see why it plays such a big role. Now, America, as I've spoken on my last two presentations, has been printing money like crazy. And so I'm not going to unpack everything in detail. Please watch our previous videos that you'll find on our website or on our YouTube channel. I'm just going to illustrate what has happened between our last presentation and this presentation. So the first thing you'll notice is that red circle. You can see that the America's printing of money has increased tremendously, nearly by $1 trillion. It looks like such a small figure on this graph, but it's $1 trillion in just a matter of a few months. If we look at the US debt to GDP ratio, once again, this too has gone up from last year to this year. Then consumer debt to GDP. This is something that I've not touched on in previous presentations, and I'm going to touch on this. And not just is this something that I thought to bring in just to show you what's going on the ground, but I'm going to show you that all of these points that I'm going to highlight now in this segment of the video, when we bring them together, you will realize why I am so convinced that we are nearing a big market crash. And of late, this is a topic that many other people have spoken of. And as my clients will know, the link that I sent out to you on the article on gold, why it's such a good time to be in something as gold right now. If you look at that same slide as the previous one, zoomed into the last few years, you will see that the consumer debt to GDP ratio has come down in the last few years. Trump was very aggressive on this to bring down the debt of the average Joe on the street in America, and they were really successful with this. But what happened in the last year is that the debt went up by 5%. Now, 5% in relation to the dollar value is just over $1 trillion. Now, to put that into perspective with South Africa's economy, that is 3 times South Africa's economy. Now, I know that America is a bigger market than South Africa, but the average person on the street in America collectively have added 3 times South Africa's entire country turnover just in the last 12 months to their debt burden. Another way to look at this is to say that they have gone back 6 years. So it took them 5 years to get from that point in 2015 to 2020. And in 12 months, they retracted all of that labor that it took them to get to that position. Now, interest rates, something we talk about every presentation, once again, is sitting at rock bottom. And if you haven't watched our previous presentations, why this is so critical, and you will see why a lot of the talk on international news and investments and economy discussions is around the hiking of the interest rates, is because America's debt to GDP is sitting at above 100%. Now, every time the interest rate goes up, it means that they have to pay back interest on the money that they've borrowed. Now, if that goes up a lot, it means that they've got to pay back a lot more money. Now, that's the reason why it's sitting at 0, because it means that they don't have to pay back the money that they've borrowed. There's no additional interest accumulating. Sorry, so not that they don't have to pay it back, but there's no interest on top of it. So if they've borrowed $7 trillion, well, the $7 trillion is parked in a bank account and they're still over $7 trillion, but it's not becoming more. Now, this is something that we are not accustomed to in South Africa. If you take out a bond to purchase a house or a loan to buy a vehicle, you can't borrow R500,000 and 6 years later without paying anything back, just give them back the R500,000. There's a lot of interest on it. Now, America has been hiding from that the last few years. And as you can see, before that, after the big crash in 2007 as well. Now, this is another news slide, which I've been speaking to all my clients about at their reviews, but I wanted to show this to you. The average PE ratio of America has hovered around the 22, 24 times mark. Now, let me explain PE ratios. Now, PE is price earnings ratio. It's the ratio at which they establish the value of a business. So Apple would be at a PE of 30. What it means is that people are buying it, hoping that one day it would go to being valued at 31 or 32 times, which means they will then make a profit. If it remains at 30, they get nothing. But it means that it's valued at more than what it is worth. Now, I don't think it's a good thing to have these big valuations, but that's besides the point. I want to show you what has happened in the last year. Now, when you look at this the slide from 2020 onwards, you can actually see how the PE has gone up astronomically. Now, let's talk about the price of food. If your hamburger from the 70s went from 10 cents to today to being 50 Rand, we all understand that concept, and we all understand that the price of hamburgers can't go back to 10 cents. It's gone up, and this is the new price, and it will potentially only ever go up. It's different when comparing the price of a hamburger to the 100-meter world record sprint time. Yes, the record can be broken. It can go from 9.8 to 9.7 seconds, but it can never go down to 5 seconds or 4 seconds. It's just impossible. In the same way, PE ratios can't just go up. It's different when the stock market goes up and when the value of businesses go up because they've generated more income, they've got more market share, they've opened up more shops. All of those things are very possible, but the PE ratio cannot go up. You can't all of a sudden say that the PE ratio of the American stock market went from 24 times to 38 times. That is just ridiculous. So when you look at the next slide, and give me a second, let me just get this thing off here. You'll see that the difference between the top investment firms in America and the small investment firms in America has changed significantly. And on this graph, you'll see that these blue lines at the bottom represents where they were within this band for many decades. I mean, for 5 decades, it stayed in this band. And all of a sudden, it shot up. And what you're seeing here is in the year 2021, it just skyrocketed. And I'm going to prove this to you by the next slide. This is such critical data, and this proved to me while we were on the right track investing into gold a year ago. This slide came out on the 15th of September last year, and it showed that the top 5 companies in America had grown their cap, which is another word for their valuations, by $1.9 billion. The rest of the stock market, which is 500 other companies, had lost $500 billion. Sorry, correction, $1.9 trillion or 1,900 billion. But when you look at these two contrasting figures and you look at the next slide, you'll see that the S&P 500 has done phenomenal. And everyone looks at this growth, and if you don't know much about investment, you would think to yourself, well, America is doing well, the stock market has recovered, the unemployment is low, so everything is going hunky-dory. And it's just not the case, because if you go back to these stats, you'll know that it is these top 5 companies that has been carrying everyone else to a higher high. When you then couple that with a PE ratio being at ludicrous figures, you'll realize that these top 5 companies have got valuations right now that is not normal. It needs to come back down to normal. But what happens when they come back to normal? I believe that the stock market has to crash. This is another slide from 2019 where Perfect had a presentation, and I'm not going to go into it in detail. You can pause the video and read this later, but the bottom line is that 50% of the bonds in America are one notch above junk status. Now, everyone wants to hammer South Africa. We're in junk status. This is terrible. We're a third world country. But yeah, you've got 50% of the investment grade bonds in the US being one notch above junk. And when you look at all these other facts that I'm pulling together, it's not just one fact or two facts. There is a mountain full of facts that is mounting to why it's very concerning being invested in the stock market globally, not just in America, because America is the leader, and whatever happens to them will ripple through to the rest of the world. I took this out of the Resco newsletter for June this year, and it really summarized exactly the way that I feel about what's going on in investments right now. And they say here that as more economic data has been released in developed economies, especially the US, our conviction has increased that rising US inflation poses a substantial risk to equity and bond returns. While this is yet to play out, and indeed may not, the risk to the downside is large enough for us to view this time as a period to preserve capital rather than chasing growth. Now, I've got clients contacting me here and there. Most of my clients are not concerned, but I do have the odd client contacting me and saying, Martinez, my daughter's investment's doing better. My friend's investments are doing better. Our investments are staying the same. Some are saying it's going down a little bit, depending on when they became our client, if it was in the last year or two. I'm of the position I am not going to chase growth right now at the expense of taking risk and losing your capital. As I explained in my previous presentation, if the same thing has to happen to us now that happened in 1930 with the Great Depression, you as a retired client stand the chance of losing 80% of your capital. Not just losing 80% of your capital, but it could take you 25 years before you get your rand for rand back. And then despite what's happened with inflation. So I'm not the only one that's got this view. Resco's got this view, and there are many other people around the world right now that's got this view. I just think that I've held this a little bit longer than the average person because I deal with retired clients that makes up more than 90% of the money that I manage. I'm very conservative in my approach to investing my clients' money. I want to talk about the illusion of banks being a safe haven or just a haven, because people often ask me, especially in a low return environment as what we are in now, I'll get asked, well, I can get 3% from money market. If I'm getting 0 with you, or 1 or 2 or 3 with you, why should I not just go into a money market? I want to explain this because this is such an important topic for us to talk about, because banks are not as safe as people think. So I'm going to break it down quickly. So on the left-hand side here, you've got Mr. Joe's bank deposit. He puts R1 million into his bank account. Well, what happens is ultimately he does not own the R1 million anymore. He has now loaned that money and put it into a bank account. That money is now the amount reflected on his bank statement that Mr. Joe is owed by the bank. Now, people often think that because we've had these bank accounts for so long and we get accustomed to taking money in and out, they don't realize that the money sits on the bank's balance sheet. It doesn't sit in your pocket anymore. So if the bank were to close, as the case was with Lehman Brothers in 2008 with a crash, you lose all your money in the bank. And it is the same with a money market account at a bank. So I'm going to say this again. If you deposit money into a money market account or a fixed deposit with a bank, and the bank goes under, you have lost all your money. Now, let me tell you that this was explained to me when I just joined the industry over a decade ago by somebody who works for a brand that is a bank. So Let me explain how our industry works and why I believe in unit trusts. Now, unit trusts and our industry with the financial services provider, with retirement products and living annuities, they are not always the best. I will be blatant about that. But there is a space here where it makes sense to invest into a unit trust. So if Mr. Joe deposits money into a unit trust, what happens is he purchases units in a fund. On his investment statement, it would say that you have bought this and this fund, you own so many units. Now, unless you buy or sell more units, the amount of units you have will remain the same. What changes every time you get a statement or when you log in online is the price of the unit. Now, from time to time, dividends can be declared and interest can be accrued. And what will happen is more units will be bought. And so your unit price can go up maybe at the end of a quarter when interest is distributed. But most of the time, your amount of units will remain the same marginally. And the price is the thing that fluctuates. So later when I discuss our strategy with our the part of the money that we put into long term and the price changes, all that's happening is the price of the units are changing, but your units remain the same. And that's why it's safe investing that way. But I'll get to that later. So now you've got your money in a unit trust. The unit trust and the funds are owned by trusts. So let's say ABC Fund Managers, who is the biggest company in the country, closes down one of their funds, or the entire company goes bankrupt and all their funds close down. The funds still exist because they're held in separate unit trust bank accounts. And so, or at least the shares are held in those unit trusts. And what that means is if the company did not work well with their own budget and they went bankrupt, the value of your asset is still lying somewhere and it has not been touched at all. So if the company goes under, you can still get your money out at the end of the day. Another company will probably buy them out, take the shares over. These things have happened before, but your money is safe. Yes, the underlying asset. So let's say your money is invested into DEF share. The price of that share goes down by 10%. Yes, when you then repurchase your money, it will be worth less 10%. But your money is still the same. If it has gone up, your money still would have gone up. So it's just a very interesting point that banks are not the haven that people think that they are. So the point is, if I'm investing 100% of your money in a money market, it is safer than you going to a bank and investing it also into a money market. Yes, the banks that are underlying this money market fund, one of them might close down, two of them could close down, and you could lose that portion of it. But the money markets are split over many, many different instruments. And so they're not just in one or two or five banks. There are many banks and many corporates that will also issue these money market instruments that the fund managers can purchase. So you can often see a money market fund has got 100 different places where the money is invested. So it is far more diversified than a money market with a bank. This is an article that came out in July this year where ABSA closed their money market unit trust for good. And I'll tell you why I'm concerned about this. So let's read here. ABSA is ending its 25-year-old money market unit trust because it says many investors mistakenly believe it guarantees returns. Investments will be paid out or they can reinvest into another fund by 1 July 2021. Interest rates have dropped considerably. They're saying to clients to rather move their money to a savings account. It's simply the pressure of lower interest rates on the fee. Now, I want to jump back to the slide and I'll tell you why it concerns me. So ABSA is saying to people, take your money out of our money market fund, which is their listed money market fund which would fall into the category here on the right, the one that is safer. And we are telling you to put the money into our bank account. We will give you a similar return if it's big amounts, but it's safer. You can't lose your money. This is quite blatantly a lie, and I think that it is very dangerous. And I am concerned that if this is the case, the question that I'm wondering about is, if ABSA wants to do this, is there any hidden agendas? Do we need to be concerned about something? Because why close down the biggest money market fund in the entire country? Why would you want to do that and lose out on that growth when you want people to put their money into their bank accounts? Is there a liquidity problem with ABSA? I don't know. But I am concerned about it, and I don't believe that it's safer to put your money there than into a money market fund. Because if that's the case, then everyone should close down money market funds and we should not have them at all. And I don't believe that's the case. Let me get into our strategy. This is now the second part to the leg on how we manage our clients' money. So the first one was active management, knowing what's going on in the world. And the second one is a strategy. This is something that I developed around 2012, 2013. And over the years, I've worked on this and just chipped away at any imperfections to get the strategy to work as well as it works now. So I'm going to explain this in detail. The reason I've never explained this before is because it is a trade secret. It is something that I've developed myself for 5-2 Investments, and it is something that sets us apart. But I'm going to share it today because we are moving into a position where 5-2 Investments is trying to take a bigger market cap, and we are trying to get more brokers to join us and for them to see what we've got. Interesting to note, our software has been built around the system, and it streamlines brokers' businesses, and it can help them manage their businesses a lot more effectively with a lot less risk. So let's look at it. So an average retired client will give their money to us, and we will invest it into 6 different places. They are categorized with us year 1, 2, 3, 4, 5, and 6. And you'll see in a moment why. What happens is that every one of these different categories is going into a different risk profiler fund. So the first one is going into a fund that is classified as a 1 out of 10. And I use this definition just because it's the easiest for people to relate to. 1 being the lowest risk, 8 being the highest risk. 1 would be a money market, 2 would be an income fund, 3 would be a balanced portfolio that has got a little bit of equity in it. We call them multi-asset low equity funds. 4 and 5 would be your multi-asset high equity funds, or for you as a general public, you would know these as balanced funds or moderate funds. And then 8 would be your general equity fund. Anything higher than an 8 would be a specific asset class with an equity. For example, gold or property or resources. Sometimes they classify different, but it would be when it's one asset class only. Makes it more risky than when it's all the asset classes. Even though it's still risky, you've got the diversification, which brings it from a 10 down to an 8. So this is a practical way of looking at it. So Mr. James Freedom has invested 2 million Rand with us, and he wants to draw an income of 6%. Now, 6% is 120,000 Rand for the year. And what we'll do is we will put that 6%, that 120,000 Rand, into the first category for year 1, the same amount for year 2, the same amount for year 3, year 4, and year 5. The rest, so everything else, then goes into year 6, which is 1.4 million Rand in this case. Now, what happens is the client draws this amount on a monthly basis. So that's 10,000 Rand a month for this client. And at the end of year 1, his money is now finished in that category. But now what has happened is everything else has gone up. Well, the idea is that it would go up in normal market situations. Year 2, 3, 4, and 5 all went up with inflation, and they went up with 6%. And I'm going to ignore year 6 until I get to it in a few slides. So just ignore year 6 remaining at 1.4 million rand. So year 2, 3, 4, and 5 is there. And the client now at the end of the year starts drawing an income from year 2. Now, remember, year 2 went up with 6%, which is inflation, which means that the client can now have an increased income and he can draw on that. Now, the end of year 2, the client's money in year 3, 4, and 5 have once again gone up by inflation, and the client can then start drawing on year 3's money. Now, you keep following that principle, and every year the rest of the money goes up by inflation, as you can see, and the money is depleted in that bucket. Now, what I'm showing you here is a worst case scenario. The scenario where in 5 years the markets were negative. And every year the money in the smaller buckets will go up, but the money in the last bucket does not. Now, at the end of 5 years, you have had a 5-year period in which the 6th category, year 6, has had an opportunity to grow the money that was in there, the 1.4 million rand. Now, if you work on about 80% around there, you would get growth to the tune of 2.5 million rand in total in that bucket, along with the original capital. Now, there's different ways that you can look at this. Because you don't need to touch this money for 5 years, all of the growth could have happened the same each year. So it could have been 12%, 13% each year, and it's compounded and it reaches the 80%. Or there could have been zero growth from year 1 to 4, and in year 5, there was 80% growth in 1 year. Or there could have been some growth in year 1 and some in 3 and some in 5. There could have been a mix and a match. But this is where the strategy is great, because it's irrelevant when the growth happens. And this is the peace of mind I want to give to my clients today through this presentation. It doesn't matter if this gold that we've got in this bucket in year 6, whether it does nothing or it goes sideways for a period of 2, 3, 5 years, it doesn't matter. I don't believe it will take so long, but it does not matter, because we do not need to touch that money for 5 years. Now back to this. So at the end of year 5, your investment is now worth 2.5 million rand in year 6, but all the other categories are empty. You then take the income amount and you top up the categories from 1 to 5. You are then once again left with some money in year 6, but as you'll see, it's not 1.4 now, it's 1.7. So once again, when that category grows and does well, it's off a higher base and it makes up for inflation. And therefore, your capital will keep increasing and you'll be able to draw an income based on inflation. So I'm not going to go through the rest of the spiel. You understand how it works. Each year, the years will go down, but you'll notice that now we are starting with the same income that we had at the previous year, which shows that you're able to make up for that time that you had no money in year 1 to 5 by leaving year 6 alone for a 5-year period and for it to grow. Clients, this is the reason why I am not concerned about your investments. It is the reason that I believe that we are safe where we are. It's the reason that I do not have any sleepless nights. And it's the reason why I love what I do. I have spent years developing the strategy, perfecting it, chipping away at the imperfections. And this strategy helps us not to be concerned. So when I explained that the investment that you purchase in a fund has got a unit price, it has the fluctuations of the unit price on a quarterly basis, on a monthly basis, whenever you check your investment. And that's what you are getting when you get a statement. You look at a statement, you look at your total investment, and you think, oh no, this quarter, my investment's worth less than what it was the previous quarter. But It is only because the unit price of category number 6, year 6, went down. If you look at your unit value remains the same. And category year 1 to year 5 has just drawn down slowly, and it's grown because it's in a very low risk fund and it can't lose even if the stock market crashes. So you're in a position where you need to separate these two. You need to look at your year 1 to 5, and if they will draw down the income on a monthly basis, but there will still be growth because it's in a low risk portfolio. And if you look at that, then you've got no problem for a 5-year period and nothing really can go wrong there. On the other hand, you've got an investment that will fluctuate. You cannot expect it not to fluctuate. Equity always fluctuates. It could be down for 2 years before it picks up growth. Remember in 2016, those of you that were my clients, we invested in Coronation's Global Emerging Market Fund. And the fund did 33% in the year, I think it was 2016 to 2017. And we then jumped out of it. So sometimes you've got to be in a fund for a year or two before the growth comes through. But when that growth does come through within that 5-year period, you are then safe. Now, it's very rare that funds and decisions that we make won't do well in a 5-year period. So what I'm asking in essence of my clients, when looking at your statements, separate these two. Go back, check your previous statements, and you'll notice that the only thing that's fluctuating is the year 6. And so what I'm saying is, please do not be concerned, because it's something that we don't need to touch for a really long period. I've spent lots of time putting the strategy together so that you can have peaceful nights and not sleepless nights. So please look at those statements, and then you'll see what I'm talking about, and you can then have peace of mind. Anyone else who's interested in contacting us, our details are on the screen here. You can get hold of me at any time, email me, check out our website. We've put a lot of effort into our website to show you the presentations that we've done before, so you can go and look at our previous presentations. You can also see testimonies of clients of ours. Some of them have been with us for a decade. So go and have a look at that, and do contact me if you've got any questions or you are interested in us to come and see you and potentially becoming our client. So thank you to everyone watching this presentation. It has been great to discuss this with you and to share this so that you can know that we do know what we are talking about, and that we've got your back, and that we will keep your money safe. Thank you for joining this presentation, and God bless. Goodbye.